All right. We're going to kind of ad lib here. We got Johnny Seville on with us tonight, so I'm not going to take up any more time. The way we're going to do it is I'm going to put up the charts and Johnny will do the explanations. So welcome, Johnny. Sorry for the technical problems, but go ahead and take it away.
Thank you so much, Steve. And how are everybody? Just for everyone's explanation, we have been sitting here actually for the last hour and a bit, testing and trying to get through the technical glitch, but it doesn't seem to be cooperating. So I wanted to thank everyone for your patience, and rather than reschedule, I know this is an important time in the market. It's a very timely presentation, so I wanted you to get the information right away, and we'll work through this as we've got a workaround going on in the background. So yeah, great to have you all tonight, guys. I am Australian in Australia.
Hold on for one more second, Johnny. Yeah, your sound is rough. Jim, what can we do to get his sound up better?
Tell you what, I'll sit back down and see if that's clearer.
Yeah. Okay. Yeah. You're now it sounds better.
Oh, great. Okay. I have one of these bad habits of when I'm talking, I love to get up and pace around, and sometimes that can cause distortion. So I'll stay put. How about that? So guys, thanks very much, Steve. All right, so guys, of course the presentation today is all about how to chart through volatility and profit from uncertain markets and, dare I say, bearish market conditions. The obviously, quick disclaimer in lieu of the disclaimer. This is for educational purposes only, not a recommendation to buy or sell any of the securities discussed. Acorn Wealth Corp and Smart Money Trading are not a registered financial advisor in the jurisdiction or province. However, many of the positions that we discussed today may be positions that I personally hold, or the Acorn trading account, or the employees and contractors of Acorn Wealth. Okay, so why is this such an uncertain market, and what are some of the key things that we want to be aware of? Now, we may have my slides pop up here in about 5-10 minutes or so if our workaround works. But let's dive straight on into the charts, because, of course, that is the topic, how to chart our way through volatility. So when we look at designing a system, right, systems are the key to consistent long-term profitable trading, right? A lot of people, when they go about their investments, will flip from one indicator to the next, to the next, to the next, looking for the next hot stock tip kind of thing, trying to get lucky. But that, although there's short-term wins we can all talk about, it doesn't usually work long-term, because for long-term consistent profitability, you need to have a system with consistent rules, how you analyze the market, how you decide whether you're going long or short, how you therefore then scan for long or short ideas. There needs to be consistency throughout all of those steps. And so when we look at the current market conditions, what I'm going to share with you today is not based on my opinion. It's not based on how I feel. It's not based on the talking heads. All it is following consistent rule-based data and charts to decide what we should best do next. And again, we're going completely ad lib today, so we're just going to talk straight from the charts. And we'll start out with the S&P 500. So if you take a look at the chart right now, we've got a yeah, that's good. So what you can see here, guys, on the S&P 500, or in this case, we're looking at the SPY. The first thing that we want to look at when analyzing an opportunity is, what is the pattern? Okay, and the reason why we want to look at that is because if you look at some of the recent estimates, say for example from JP Morgan and many other like-minded reports, they suggest anywhere between about 80 to as high as 95% of the daily volume that happens in the market each day comes from algorithms, right, or computerized trading. And so algorithms, the advantage to this is that algorithms don't think. They're just simply following rules and patterns. They're pre-programmed when to buy, when to sell, and do that again and again and again and again. So one of the benefits of algorithmic trading and what exists in the market is that we have this ability to reverse engineer them. Right? They do happen very much the same way over and over and over. And so when we look at the pattern, what we're doing here essentially is we're wanting to put the probability of those algorithms behind us rather than fighting against them. Right? If we can be going in the same direction as 80% or 90% of the daily volume, that's immediately going to put us ahead of the game. So when we look at the S&P 500 right now, what pattern does most people here in the room see? Is there anything that jumps out to you when we look at the pattern over these last few months? You know, June, July, even back to May. So what we should see, and the first question we would ask, and Steve's even drawing it out there with the mouse there, we can see that we've been kind of oscillating back and forth. Okay. Now, one of the when you look at these moving averages here right now, we can see that that thick blue line, your 50, has been holding it up relatively well. But if you look at what I believe there is the 9 and 20, you can see we've kind of been cutting back and forth a fair bit on the throughout this rally. And what we can then observe from that is where is our top end resistance and our bottom end resistance. And if we were to draw a line through all of those tops, from the May top through to July top, all the way up to the top we hit yesterday, what you'll see is that we kind of have almost like a channel that we have been rallying within. So this has clearly been holding a bullish trend for the time being, but we are getting some signs of certainly some warning signs. The rules typically of an upward channel is that after 3 touches along support, which we can see we've had there in May, late June, and July, that on the 4th touch, this is a high probability time for us to break down, and typically the amount that will break down is the distance between the top of the channel and the bottom of the channel. So now we have not broken down yet. This would be the key kind of signal that we would be looking for a more serious or higher pressure break to the downside. Is you can see that this would be a break of that, not only that moving average, but a 4th touch along that support, and that's where we would be looking for a bearish break on the S&P. Now, so what I've been talking about here so far is the S&P 500, right? And this is often what is referred to as the market. You know, what did the market do today? What did the market do yesterday? When people are talking about the market, often they are referring to what the S&P 500 did. However, there is one layer deeper. If we start to scratch beneath the surface, just remember that the S&P 500 is fairly heavily manipulated, right? That the top five stocks in the S&P, Google, Microsoft, Facebook, Apple, etc., those make up over 20%, give or take, of the S&P 500's weighting. And so I'd like to pose a question to everyone here in the audience. How many people here over the last couple of months, let's just say, you know, June, July, August, last 3 months, how many people here have found their trading has been much more difficult than usual, right? How many people here have been watching the S&P 500 climb to record level highs, but haven't felt their portfolio is making record level profits week to week, month to month? If you've been noticing that, give me a 1 in the chat box. Give me a 1 in the chat box if you're looking at the market going higher and higher and higher, but you're seeing more stop outs, you're seeing stocks going down. Yeah, lots of 1s. So let me explain why. So if we can move from a chart of the market, so to speak, and let's go to the Russell 2000. Let's go to IWM. And if we take a look at the Russell 2000, this is where we are seeing a far better, yeah, and if we could zoom out a little bit, but even on that chart, what you can see over that same time frame that we just looked at on the S&P 500, over May, June, July, August, would you say that the Russell 2000 has been bullish or bearish? Right? You can actually see that what we've experienced over the last several months has been very sideways, and if there has been any trend at all, it's been down over the last few months. We've come from a high of around 235 to a low only just a few days ago of 210. Right? So there has been a lot of pressure on individual stocks in the market, and any gains that have been made have been quickly given up. And we're going to see that a really interesting representation of that here in a moment if my slides do pop up. But that is a stark difference to what the S&P 500 has been appearing to do. All right. Now, there is one other chart that we can look at, which will tell us a bit of insight into what is really going on behind the scenes, and that chart is high yield bonds. If we can pull up HYG on the chart, potentially. Okay. Now, high yield bonds are a very interesting representation of smart money. We are big believers in following what the smart money is doing, because they have an insight into global events. They have knowledge, of course, that we can possibly have access to, deeper pockets, and especially when you account for the smart money in terms of the algorithms, they account for close to as much as 90% of the volume each day. So these are certainly things that we want to be aware of, and they can give us tremendous insight. So with high yield bonds, what they can give us insight into is what the bond market thinks of the stock market. Just to put it in really simple terms, high yield bonds, or another term for them are corporate junk bonds, is a place where if big money, the bond market, and they are really smart money, the bond market is substantially bigger than the stock market many times over, right? So you're dealing with really big money, Fortune 500 CEOs, central banks. When the bond market likes the stock market, they will buy corporate junk bonds. It's one way that they can create exposure to corporate America and get a return. And so if the bond market is feeling bullish about corporate America, about the stock market, you'll see corporate high yield bonds go up as the demand for those increase. And the price of HYG reflects that, right? So what you should see, unlike other bonds, is high yield bonds will move in correlation with the market, with the S&P 500. When the S&P is going up, the market's getting stronger. high yield bonds should be going up with it. And so this is a very powerful leading indicator that lets us know when there could be trouble afoot. Is that making sense so far, guys? Just give me a 1 in the chat box if I'm explaining that clearly enough. Okay, great. Now, what we see in high yield bonds, and in fact, Steve is one step ahead there doing that, doing those trend lines. Thank you. So what you're actually seeing here is that we have the a kind of an oscillation channel that's pointing to the downside. Okay, so what does that tell us? What does that pattern suggest? So we've got the S&P 500 an upward channel, so still bullish for the time being, right? Bouncing along support. You've got high yield bonds in a downward pointing channel or even a falling wedge. So what does that potentially suggest from high yield bonds? It suggests that high yield bonds want to go higher. If we break out above that resistance line that you can see on the chart, it suggests that high yield bonds want to break out just a little bit further. All right. So S&P moving upward with a bearish warning in its pattern. High yield bonds with a bullish pattern, so a short-term upward move potential. Russell 2000 is in it has been a bearish decline in sideways oscillation basically since February is how far that goes back. So what are we seeing so far in the charts when we think about the message that the charts are telling us, right? The message that the chart is telling us is that we could be nearing at least a short-term top. You know, now there are some strong opinions about the strength of a decline. There are some analysts that feel that this would be a crash of epic proportions that's coming all the way down to 2008 kind of levels. You know, a massive bubble pop. There is some analysis on that. There is, and then there's just as equally strong arguments to say that, well, look, we're just going to continue to print money, and then there's going to be great economic growth, especially coming out of the recovery, and things, and any pullbacks will be limited to 10 or 20%. The problem is that when you start to get into locking yourself into a position of saying this market is going to have an epic crash. The problem with locking yourself into a mindset like that is you can ignore bullish signals if things were to change. You can start to hold on to your shorts too long and not take profit because you're getting greedy. And likewise, the same goes for a bullish-minded investor or trader. If you start locking yourself into this market will never go down, and a potential crash is not something I think is likely, then once again you can also get too bullish and miss all the signs for a decline. And so I'm going to show you here. See if okay, my slides actually finally came up. Can everybody see those now? Yep, excellent. So I'm just going to fast forward a little bit. Excuse me. I'm just going to fast forward. So if we take a look at some of the previous crashes that we've seen in the market, I'd like to show you how these charts start to play in the past. So we've talked about the indexes so far, right? And thank you so much, Stephen, for helping me with that. But that's basically what we've just talked about. We've got the index. We've had the Russell 2000. Okay, we've had the Russell 2000, and so as we dive into some of these indicators, just going again, you have to apologise because we are. Yeah, here we go. So this is high yield bonds in 2020. So high yield bonds in 2020 had this long-term upward channel. Can everyone see that? We talked about this with respect to the S&P, but you can see this long-term channel in 2020. This is why it's such a strong leading indicator, because it was one of the primary reasons we were on such high alert at the end of 2019, was because we were at the top of an upward channel, much like the S&P is now. And so why I talk about not locking yourself into a position is that what we prefer to do is to look at what the charts are telling us and assume the worst, plan for the worst, hope for the best. So right now, the signs that we're getting from these indicators are quite ominously bearish. They're quite nasty, and here's why. So there's high yield bonds in 2020, top of an upward channel. We broke down, and it got much worse very quickly. Okay, as you can see, we declined steeply, and that is the warning that we're getting now. If you take a look at the chart of high yield bonds right now from a much longer term perspective, this is going back to the beginning of last year. What pattern do you see on high yield bonds from a much longer time frame perspective? We looked at the short term. What do you see from the long term? A rising wedge. So, right? So while we have a short-term downward channel, which gives us a short-term likely pop in high-yield bonds, the problem with that is that where that pop takes us to is almost exactly that rising wedge resistance that we have broken down from a few weeks ago. Okay, so this to me is one of the most concerning charts of all, is that as of a few weeks ago, as the Russell 2000 broke down about 15% very quickly, as the Russell 2000 broke down 15% from its highs, high yield bonds broke beneath their levels of support for the first time since the beginning of the recovery. It's the first time we've broken through that support. We have a potentially bearish upward channel on the S&P, which would suggest possibly more bullishness, but within certainly at least at very least a warning from the pattern. And we're seeing all of these kind of fit together. And what they're doing is they're telling us a story that at the very least we should be very cautious. If we're going to take longs, they better be really, really, really good ones. Right? We shouldn't be just trading any stock, any old pattern, where anything can go up, because in fact it's the opposite right now. There's only a certain amount of stocks going up. Most of the market is either has been pulling back or is stuck in a sideways trading zone. And so this should hopefully explain a lot of what's going on beneath the surface and why when you're looking at the S&P 500, seeing it make record highs, why your portfolio isn't reflecting that, because there are these kind of really powerful divergences going on. Is that clear, guys, what we've got from the chart on high yield bonds there? Give me a one in the chat box if that's all making sense so far. All right, cool. And then if you want to see this reflected in another way, and again, I do apologize that we're bouncing around a slide deck in a we're making good, aren't we, I think. So this is another indicator which shows this story really, really well. Again, data rather than opinions. My opinion's worth no more than anyone else out there, which is why I try to put my opinion aside and focus on what the data and the charts are telling us to chart our way through volatility, follow the rules, try and put our opinions and emotions aside. And so so high yield bonds is a great way to do that. And this is another great way to do that. This is a data-driven indicator that tells us, rather than what the S&P is doing, rather than what the Russell is doing, this looks at the market itself, the real market. Okay, so instead of saying the market's up, the market's down, there's no such thing as the stock market. It is a market of individual stocks. Right? That's what you're buying. That's what you're shorting. That's what you're doing options on, the individual stocks in the market. So if we're going to talk about what the market's doing, let's look at the market. You know what I mean? On top of the indexes. Let's go deeper. And this indicator shows us that. It shows us what percentage of all of the stocks in the market are above their 50-day support. Right? So I've seen a few people comment in the audience about we're pulling back to the moving average, we're pulling back to the 50. These kinds of things. So yes, this is because these are very important support levels, right? So when we look at this chart, it tells us an instant truth of what's going on behind the scenes. Yes, I was getting excited and talking louder. My microphone may be extra sensitive there. What you can see before the 2020 crash, in middle of December, this chart shows you that 75% roughly of individual stocks were above their 50-day moving average support. Right, the 50-day moving average is where institutions buy, hedge funds, mutual funds, all that kind of stuff. It's a really key level, as you all probably know. So watching this percentage, which is what you see on the right-hand side, on that y-axis, that's really, really valuable. Because if you go back over the last 20 years, what you'll find is that whenever you get to around 70% or above, this is a turning point of where that trend shifts downwards. And I think it's about 85% of the time, maybe a little bit, I think it might have been 83%, but I mean, look, it's above 80. Above 80% of the time, once you hit 70% or above, it turns down and we shift to a bearish trend within 1 week. Within 1 week, 80% of the time you hit this level or above, individual stocks start breaking down. So this is really fascinating because it allows us to get timing on what we're doing with our money and whether we want to be strongly bullish or more cautious. A great example of this was in 2018. Well, I'll show you 2020 again in a second, but the 2018 again. Can everyone see here that before that the big drop of the market in October, right? You look at the S&P 500, the market really plummeted in October. That was a big crash. It started from October all the way through till December. October through December. Prior to October, the S&P 500 went higher and higher and higher and higher. It actually made record level highs. So, of course, what's the news going to be saying? Peak optimism. The news is going to be saying how wonderful things are, right? And the S&P 500 appeared to reflect that. But once again, when you scratch beneath the surface and you look at the data, you can see that in June of 2018, 72% of stocks were above their 50-day moving average. And just like I've mentioned before, that is exactly where it turned down from. And while the S&P 500 went higher and higher and higher, individual stocks in the market went the opposite way. They went from 72% to only 36% of stocks still above their 50-day moving average before the S&P even began to drop, right? So again, same thing in 2020. 75% above the 50-day moving average, and that was down to 35% before the S&P 500 began to crash, right? This is it reflected on the chart itself. That's where we hit 70% right there, in the middle of December. That was when we got our warning, and it was long into its decline before the S&P began its drop. So once again, if I can just get a quick feedback from the audience, it's making sense. I mean, I hope this is as fascinating to you as it is to me. And so the takeaway from this indicator is what? What is this indicator telling us? Well, let's take a look at what it's showing us right now. Right? Let's take a look at what this indicator is showing us right now. We actually went to an even higher level in February. In February, we went to as high as 85%. So once again, that rule still applies. Whenever we get to 70% or higher, we expect a turn within 1 week. It's the high probability time frame, 1 week. If it doesn't happen within 1 week, it usually lasts for about a month, just so you understand the application of this. Very high probability it happens within 1 week, but usually no longer than a month. And so what you can see here is exactly that. Once again, earlier this year, in February, we reached this peak. But ever since February, what can you see has been happening with individual stocks? Okay. So for those of you asking 70% of which stocks, this is all stocks in the entire market. What percentage of them are above their 50-day moving average? So what you can see here when we look at the market as a whole is we can see that we have gone from 85% above the 50-day to a recent low of only 22%. Isn't that crazy? Right? That's what we're seeing right now. That's a massive divergence. Most recently, only a matter of in June. In June, we hit 70% of stocks. 1 week later, we began the downtrend, and we dropped just in a couple of weeks, 4 weeks. We dropped from 70% of stocks above the 50 down to 22%. That is so that is why, for everybody who said they had been struggling over these last 4 weeks and not making as much money as they would expect to with record high markets, does this start to clear up, some of the answers as to what's happening behind the scenes? Right? So with that in mind, let's take this one step further. Right? And about the bond market, let's take this one step further. Let's talk about what the insiders are doing. So just to recap, S&P 500 in an upward channel, which is bullish for now, but is a bearish pattern. If that upward channel plays out and it breaks that moving average support, we're looking at a bear market move on the S&P. Russell 2000, already in kind of a sideways market, a choppy, noisy market with a recent bearish trend. We're seeing high-yield bonds. The most bearish of all of those things is high-yield bonds, as we have broken through 2-year support levels that have not been broken through once, and we are rallying up into that resistance from beneath. We're seeing the amount of stocks above their 50-day moving average having diverged from 70% down to 22% just over the last few weeks, while the S&P rockets higher. So all of these things are telling us that there's a very big warning signs. That if we are going to go long, it should only be very, very good longs. We should have tight risk management, and we shouldn't be afraid to take profit on the way up at the appropriate places as these longs hit targets in order to plan for the worst and hope for the best. So if it only goes up 10 or 20%, let's lock in. Let's take 30% of that off the top. Let's move our stop loss above our entry price so that we can play with the house's money. So if the whole market comes crumbling down the very next day, that we've at least profited from those positions and have protected our capital. Does that make sense? So one step further we can go from these takeaways so far, as we chart our way through volatility, is to look at what the insiders are telling us. And this is where we get to go one layer deeper beyond the charts and actually consider the fundamentals. So, we're not big fundamentalists. I'm not going to stand out here and say I'm one of the best economic theorists or fundamentalists out there. That's not my specialty. Right? My niche is patterns and tracking the smart money. But the reason I do that is because I believe that is one of the best forms of fundamental research you can get. Right? Again, let's talk about 2020. Let's talk about how many people in here got hurt by that. How many people in here by one got hurt by the 2020 crash, and a two if you missed the buying opportunity. Maybe it's a one and a two. Right? Twos, ones, okay. So one group of investors didn't miss either of those opportunities. If you take a look at the selling, the insider selling for the 90 days before the 2020 crash, there was quite a fair bit of insider selling. Proportionately, also significantly more selling than buying. What did they know? How did they know it? Right? And even more fascinating than that, if you take a look at when the market bottomed in March of 2020, they bought back big time. Right? It wasn't just a few shares. The insiders bought back record level amounts of shares. This had only been seen one time recently in recent history. And do you know when it was? Do you know when the last time it was when the insiders bought back record levels of billions of dollars of their own companies? It was the lows of the crash in 2009. The last two times insiders bought like this, it was at the very bottom of some of the worst crashes we've seen in our investment careers. Again, it was record levels. It was billions. And it was actually, this started, this massive spike in insider buying. Guess what? It was 4 days off of the absolute lowest the market got. So while everyone else was panicking, and while the news was reporting this huge market meltdown, insiders loaded up. And therefore, is it no surprise that what we have seen over these last 2 years is the rich get a lot richer? Right? Now, some traders or investors may argue, well, look, 2020 was a bad drop, but look, I didn't sell any. I just held strong, and I've recovered. But the difference between that and what some of these insiders did was, that they sold at the top. Let's say at $100 a share. The stock then dropped to $10 a share, and they loaded back up. Well, think about that. When a stock drops from 100 to 20, that may only be an 80% drop, and then if it recovers, you're back to even. But when people sell at the top and buy back at close to the bottom, and that recovers from $20 to 100, that's not an 80% recovery. That's a 500% rally. Does that make sense, guys? When something drops from 100 to 20, it's an 80% drop. but when it goes back from 20 to 100 and recovers, it's a 500% rally. And that's why we've seen, when you look at some of these insider trades, hundreds of millions of dollars that have been made by individuals in some cases, taking advantage of those highs and lows. And that is why when I start to then look at the insiders selling over the last 3 months, and this is a couple of weeks old because there was a bogus trade that happened that hasn't been fixed in the reporting on the SEC, so it threw the numbers off. So I used this chart from just a few weeks ago, but it's basically exactly the same. When you look at the last 3 months, what can you see from the insiders right now? $30 billion in services sector selling alone, right? So you're dealing with $45 billion plus of insider selling. Now, does this make sense, guys? John says, I wish I had this info in 2020. Well, this is why we're here today. This is why, we pushed through all the technical glitches to make sure we could chat and bring this to your attention, because I really want you to be aware of the data, because this isn't about convincing you the market's going to crash. I'm not trying to convince you it's going to rally either. What we do at Acorn is we present the data, and these patterns and this data will give us probability, one direction or the other. And this allows us then to make decisions based on rules and adjust our risk tolerance or what direction we're trading in based on what the rules are telling us. And then when we combine the action of the insiders behind that, that then gives us that fundamental strength behind the move as well of data that we couldn't possibly tap into. The fundamentals, new product launches, mergers and acquisitions, new customer contracts, litigation and court cases, medical breakthroughs. We'll talk about this in a second, but this piggybacking the insiders and the smart money as a holistic strategy, to me, is the edge you need in a market like this, combined with, of course, all the wonderful things that you've learned at Candlestick Forum and other things that you've done in your trading career. So if we take what knowledge we have put together collectively today, we can then apply this same kind of rule-driven strategy to look at individual trades. Okay, and as this might sound sophisticated, it is sophisticated, but it's simple to follow. We're trying to reduce the amount of noise down to the simple but powerful things that work. Now, I'm going to talk about some shorts in a minute on Piton, on Dollar Tree, things like that we had found using the strategy. But I'll start off with some couple of longs. SAVA. So I've mentioned that if you're going to go long, we only want to buy the very, very best ones. So I want to show you what kind of longs I would still buy right now, even though I think that there is a very high probability of at least a 10%, maybe 20% correction, and which could get worse, even though there are a lot of warning signs that could be around the corner. There are still longs that I would buy. And these are the qualities. This is what I'm looking for in a long. So SAVA was one we've taken before. This is Cassava Sciences. Now on SAVA, when we found this one, this was a beautiful momentum breakout. Now again, a lot of comments about moving averages. This is a momentum stock. This stock had broken out above its 5, 9, 8-day, 20-day moving average. It was just breaking through its 50-day moving average. It was breaking through a short-term downward channel, everything. But alongside that, would that be enough to go long in this market? No. To me, that wouldn't be enough because what we wanted to add to that is, of course, the fundamentals. Is there something that can make this setup that much better so that even if there was a market, if there was market trouble, that we felt this stock could rally regardless of market conditions? And this is where we were in the middle of December, was exactly where we are now, based on the rules, right? Obviously, we're in a different time frame. There's different things threatening the market. But from a technical perspective, We had the same warnings from high yield bonds, the same warnings from stocks above the 50-day moving average, heavy insider selling, all of that, all of those warning signals that we're getting today was very similar to what we had in December of 2019. So from a rule-driven research standpoint, my mindset then in December 2019 is the same as it is right now. So that's one of the reasons why I wanted to show you this one. So we saw the pattern, and what happened as well was we saw all the insiders loading up. Director, Chief Financial Officer, President, CEO. One director bought 177% more in just one purchase for 932 grand. So people don't wake up, roll out of bed and decide to load up 177% more with almost $1 million in a stock that they are heavily involved with on the inside without some really, really high conviction, right? And that's what we saw in Seville. That went from, I think we alerted it around $2.30 as it broke through that resistance. That had a very quick pop to around 9. But that, in fact, again, I couldn't show you the slide because this is I couldn't add it in there on my live screen. But if you were to take a look at that, SAVA continued on all the way up to $150 from 2. So this is a monster move, which came with not only a high probability pattern but massive insider buying. Those are the kinds of longs I'm looking for now, right? So these kind of extra qualities. AVEO is another one, real trade that we did. This is again, I want to put in some of these things we talked about in perspective. So if you take a look at AVEO, this is where we've got very similar kind of pattern that we saw in high yield bonds. It's a downward channel that was breaking to the upside, breaking through the trend line. So there's our entry point, right there around $6.28. So if this were a chart we were looking at today, would I take this on its own? Probably not. It's a very good pattern. But because I'm so concerned about the market conditions, I want to add as many extra factors to increase my probability as possible. So we'll zoom out a little bit. Look at the weekly chart. Okay. Now we've gone from the daily to the weekly. We're looking at a period of about 2 years, a bit more than 2 years. And you can see here, this is actually what we call a fallen angel trade or pattern. Or a cup and handle is another way some people like to look at it, but it's a bit more advanced than that on a fallen angel, but very similar to a cup and handle, right? You've got a nice downward oscillation, big scoop down the bottom. Up we go, pull back to support. This is a very powerful momentum setup. And if you take a look at this chart, where do you think the target would be? 18 bucks. Yep. Well, 18 bucks. So now let's go from the pattern. We've got a high probability daily pattern, high probability weekly pattern. Look at the insiders. What are the insiders doing? Okay, we have the 10% owners, right? 7 10% owners buying 57% more each for over $7.5 million. So now we have a great daily pattern, a great weekly pattern, and we have about $150 million worth of buying. About $50 million worth of buying. $50 million worth of buying from the 7 10% owners that therefore by assumption already own 70% of the company or more as a group are buying even more. Well, surely something good might be about to happen. So this then lined up with, of course, all of our checkboxes. Because at the end of the day, what do I know about a pharmaceutical company and whether they're going to be FDA approved? But I would sure hope that the 7 10% owners putting millions of dollars in would have some kind of an idea. And so I do get very excited about these kinds of setups, and you could probably tell earlier when my microphone was going out of whack because I started to jump up and bounce around in front of my screen, because this is this is stuff that I'm looking for myself. These aren't just trades we're publishing to a newsletter or something. This is how I manage my own money. This is how we manage the corporate trading fund. This is how our traders at Acorn Wealth manage theirs. So, we put a little bit more than I probably would have in this because of such significant insider buying. We bought about what did we buy? $25,000 worth of stock at $6.96 as it broke out. We then preset to sell at $18. So when we bought, we pre-programmed where we were going to enter, we pre-programmed where we were going to exit, and we pre-programmed our stop loss. So what ended up happening is, of course, this stock inevitably actually had some really good news on one of their drugs, and the stock shot up overnight from $8 to $18. Now, this is where kind of one of the last pieces to the puzzle falls into place, where especially in a noisy market and a volatile market, it's very easy to start second-guessing decisions you make, watching it go up 5%, down 4%, up 10%, down 6%. Especially in volatile markets, it's so important to try and get away from the noise. And so in a trade like this, and all trades that we alert, we always have a set and forget style strategy, a plan for where we will get in and where we will exit based on the rules and patterns. And so this setup, we pre-programmed all of that, including the exit at 18. Now this is why this is so valuable, because the news on that day was that they had some extremely good news on their drug. The chat rooms were blowing up. It was one of the most talked about stocks on StockTwits for a moment there. And emotionally, if I had been sitting there in the morning watching the pre-open when it was up as high as $19 and change, with all of this good news and chatter, what do you think you would have done emotionally? Ask yourself that. If you saw the stock up big time, great news on their drug, do you think you would have said, you know what, it's at my target, I'm going to sell? Or do you think you would have held on and gotten greedy? Be honest, what do you think you would have done? Number one, sell. Number two, gotten greedy. Bill says I would have cancelled the stop. Yeah. Number two, gotten greedy, says Tom. Yep. Okay. Well, I'll tell you what I would do. I'm humble enough to say that I would have gotten greedy. I would have broken my rules. I would have not sold, and I would have looked for more profit. Right? It would have been easy to become emotional about that scenario because of the news. But what do the rules tell us? The rules tell us to sell. That's a huge move straight into a weekly heavy resistance, which is the perfect target. So luckily for me, I'm in Australia. So I'm sleeping when the market's open for the time that I'm here. So I did have my target programmed in. So when the market opened, it filled that entire order at $17.80, which was a $38,700 profit for about a 2-week hold. That was an incredibly exciting trade, not just because of the money, because it was textbook perfect, and because it went all the way back down to around, I think it was about $10 in the days after. So it reinforced how important keeping to your rules are. And so you can see all of that filled out. Now, you didn't have to trade the same size that we did of 25 grand, but you could have put in $250. That would have been a $387 profit. Or $2,500 would have been a $3,800 profit. Regardless of what you're trading with, why I love these types of setups is because even if you only made $387, that's not bad, considering it only took us about 20 minutes to find it in our scan, searching for these smart money setups with the big insider buying. It takes about 20 minutes for us to run the scan and find a good trade. And once we've decided on that one or two trades, we then program our entry, our exit, our stop loss, that trade is now on autopilot. If you didn't touch it again, you've got your stop loss and your target programmed in. If you lost internet for a month, you're still okay, right? Or even better, you program that trade in, and every few days you come back to look at it and move your stop loss up to protect the profit you're making while it's on its way to its target. Does that make sense? Right? So when it's such efficient trading, even a $387 profit is a wonderful payoff because it only took you 20 minutes of work. I'm sure everyone here would be happy to make $400 every 20 minutes. Not a bad pay. And this is why, your money working for you is the goal in this. On the short side, we have the services sector. So let's revert to the bearish arguments now. We talked earlier about all of these heavy levels of selling, the $30 billion worth of selling we saw in services. So if we're sitting here saying, okay, warning signal on the S&P, bearish to sideways movement on the Russell, high yield bonds have broken down big time from their 2-year support, and there's $40 billion of insider selling, $45 billion of insider selling across the market. Okay, so where should we find these juicy shorts, right? We look at the stocks above the 50-day moving average. If we've dropped from 70% of stocks being above their 50-day moving average to only 22% of stocks above their 50-day moving average over that recent 4-week period, where are those stocks? Where are those juicy shorts or those rotten apples that are going to drop from the tree first? Well, let's go to where the insiders are selling. That's a simple answer. Let's look at the sector that has the $30 billion of selling on its own, services. So if you look at Dollar Tree, DLTR, Dollar Tree was a stock that we found in our scan. If you look at Dollar Tree, everyone, what pattern was Dollar Tree? Can everyone see the rising channel? Okay. We get touched 3 times off of support. So this is now when it's due to drop. And what we also saw is that the two most recent times it had tested the resistance above, the CEO sold 57%, 58% from the chief operating officer, and another director sold 99% for $11 million. The second time it revisited that, another director sold 100%, and the chief marketing officer sold 94%. You have the CEO, COO, 2 directors, and the chief merchandising officer. Just a quick question to everyone in here. Would anyone buy a stock if they knew the CEO, chief operating officer, director, another director, and chief merchandising officer was selling, 99%, 100%? Would you buy that stock if you knew that? I hope not. Right? What would you do if I sat in here in a trading room or sent you an alert, and I said, hey guys, I found an amazing stock that I think you would all be interested in on XYZ company, and then you said to me, oh cool, John, are you going to buy it? And I said to you, oh no, I'm not buying it, I've actually just shorted it. What kind of alert service would that be? Right? No, I know I'm being a little bit extreme there. But why would I buy a stock that the CEO is selling his own shares to me? Where the chief operating officer is selling their shares to me? Why would I buy that stock? Simply because I have a choice to buy other stocks where they're actually doing the opposite, where they're loading up. Yes, you do know the selling. A couple of questions in the audience. So these are tools that we teach you. I'll talk about our Smart Money course in a minute. But this is all information is readily available to the public. We show you the tools that we use and how to get this data very, very easily on any individual stock or on the market as a whole. Yes, you do get the selling dates, when they sold, how much they sold, and the percentage they sold. It's all very, very easy. WB, timely manner. Insiders have to report it within 3 days. There's lots and lots of sites online. You can get that or directly from the SEC. But we've got it organized in a way that makes it very, very, very simple and easy. But all of the data is actually sourced from the SEC and then compiled into a format that someone like me can read it, right? So that it's simple and timely and easy to action. I'll talk about that in a minute, though, guys. For the sake of time, I know we had a slow start, so just want to make sure we finish off here. And I want to talk about, yeah. So look, there's lots of examples of this. Caesar's entertainment, the gaming company. We bought a whole bunch of puts on this one. Same reason, in the services sector. Same reason, in an upward channel. So as soon as it broke down below $98, I think it was, which is a break below that support, we bought puts. I still do own actually a few of those puts. What were the insiders doing? Massive insider selling. And so we alerted it as a put. You could also short the stock. And it's very, very simple. There's a set and forget plan. Entry at $94.22. Target $85.13. Stop loss $100.17. All pre-programmed, all set and forget, taking advantage of a setup where the market conditions from the top down all supported it. The insiders were selling it, and the algorithm suggested it was shorting as well. Okay, so does this make sense, guys? I'm going to fast forward a little bit just for the sake of time, but there are so many examples of this. If you take a look at your PTON was another one, but I wanted to show you that, but my updated slide deck was having issues, as we talked about earlier. Couldn't get the live screen to show. But if you take a look at that, well, if you take a look at Dollar Tree, DLTR, the one I was just showing you, if you take a look at its aftermarket trading today, I believe it was down pretty significantly after earnings, right? I think it was down, what, 6% or more? Surprise. Yeah, down 12% today. Down 12%. So where those insiders were dumping up at 120, we're already down now 30%. Right? That's already crashing. That is crash territory on DLTR. That's the one in the services sector with massive insider selling with a perfect upward channel pattern. If you're going to look for shorts, that's the kind of recipe we're looking for. Peloton, which also had big insider selling. They reported earnings after market today. They shot down, I think it was all the way down to 96 or close to it after market from 114. That's almost a 20% drop there post market. I think they closed a bit higher than that, but in the aftermarket trading. But this is where you get these ideas, is simply by looking for this kind of data. So again, I will fast forward and we'll talk about the offer. So again, I do apologize for the slides. This is a Jimmy rigged version. It looks a lot prettier on my screen. but this is how you can get started with this, and I'll talk about what this package includes. We have put together an awesome program for you, which we did run a special offer on this over the weekend at $9.97. Your price is actually $3.97. We wanted to do something really special for the Candlestick Forum group, and so again, just ignore the $9.97 on the screen because it has been discounted even further than that as a special offer for you today. And what it covers is everything we've talked about today. So firstly, let's talk about the alerts. And this is going to come back to a lot of the questions coming in from the audience. The smart money setups. Okay, so the smart money setups go through our 5 favorite ideas per week. So as I said, these ideas that we're looking for are not just for you. The 5 alerts that we are sending out to you each week are the same setups we're looking for ourselves. So I'll typically do a lot of my research over the weekend, on a Saturday or Sunday morning, and run all my scans looking at the market conditions, the patterns, and the insiders. And really we are searching, of course, for the very best possible trades based on those all those smart money indicators that we've talked about today. Okay? So that's the first part of it. And the really big thing here is that they are all smart money insider setups. Now, that's part one. This then comes with the set and forget rules, which are based on the patterns, the entry signal, the first target, second target, sometimes even a third target, and of course the stop loss. So this gives us our risk-reward ratios. It gives us our multiple targets so that we know if it's ideal from a risk management strategy as well, perspective, and then we can program all that in to be automated. The options, if we're looking at any options, those are of course also programmed in as well. So some of the even if I'm in an options position, I still automate it with stop losses and targets, because of course the time frame that I'm in, right, is the markets open at midnight and close at 6 in the morning. So I have to have that, but I also love the fact that I do, because it allows me to disengage emotionally and let the rules do the job. John asks, do I look at the ASX? Absolutely, I sure do. You may have heard of my father's company, Oracobra, in Australia. That's a cool company. Anyway, I do look at the Australian stocks as well, but the alerts are all based on the US market. In the trading rooms, however, we will talk about cryptos. We'll talk about US stocks, Canadian stocks, Australian stocks. In our trading room, this happens twice a week, Tuesday, Thursday, at 7 p.m. Eastern, and this is where we really break down all the other kind of things going into the market outside of those 5 favorite trade ideas. It's where you can come to ask questions about stocks you may be interested in. We can take a look at Australian stocks, Canadian stocks, gold, silver, commodities. Again, the rules by which we trade all of these are the same. The way we find them is the same, very similar. So this is a very live, actionable kind of training room. It is called trading room, but it's very much a training room where we get to practice all the things I've talked about tonight. And of course, you can ask some questions. That's twice a week, and it is recorded and then uploaded immediately to the customer portal. So if you have another trade room that you attend, or you're in a different time zone, those are uploaded immediately for you to be able to watch. Okay, and then last but not least, the scans. So what we also have included is our Smart Money trading course. The Smart Money trading course is on its own is normally $19.97. So even if you didn't follow a single alert and you just want to be able to do it yourself and incorporate the research tools and things that we've been showing you tonight, this is another huge bonus. So the Smart Money Trading course is something that will take you through, we'll take you through the tools that we use, actually we'll show you how to set up the scan using free online software. Right, so you don't need to download anything, you don't need to pay for any subscriptions. Everything that you need is included in the price of the $397. Okay, and that includes the scans. You'll have those scans are run on free online software where we configure our algorithm into it, right? And we set that up for you and show you how to do it. And then once that's set up, it's yours for life. So you can just click the button each day or each week and be presented with only the very best insider longs and insider shorts. This is something that would be of immediate benefit to you, regardless of how you trade. This is going to mean that any longs or shorts you take going forward, you now have the option to make sure they're only backed with the strongest insider activity. Okay? So, so scanning for these ideas is going to be awesome because then you're presented with a short list of top opportunities right off the bat. And what we go then in the second part of the course is then showing you how to pick from those lists. So if there's, say, 7 stocks on that list when you run it on the weekend, how do you pick the best one? And so we'll show you exactly what we're looking for, break down the highest probability patterns, and what we're looking for from that insider data. Who should be buying, how much are they buying, how old, how long ago, all those things, so that we can you can have a very precise recipe to follow when picking out your trades and executing them. Last but not least, if you do need any help at all, every one of you, as part of this special offer we put together for Candlestick Forum, you will get your own personal coach. So you'll have VIP personal coaching. If you don't like to talk to people over the phone, that's fine. But you do have the opportunity to ring us whenever you want. We'll screen share with you, take a look at the screen, help you analyze the pattern, look at the smart money scans, show you which ones are the best based on the criteria we use. Of course, you have to make the decision for yourself as to whether you buy or sell anything. But that support, that level of support is there. When you call us, someone will pick up the phone 24 hours a day, 7 days a week. You will be able to speak to a human who will take your call. Right? No one else does that. So I'm a huge believer in support. Whether you need it or not, it is there for you. You can also Skype your coach, text your coach, email your coach, any of those above. So whenever you need help, whether it's technical or whether it's trying to work through the course material, there's someone there to help you. Okay? How long do you think this system will work when more traders get in on it? It's a good question. I was asked that about 12 years ago on some of the patterns that we've traded and still trade. And, it's I don't know what the peak level would be, but the fact is that we're still, whatever that peak level is, we're a long way away from it. If you want to see the evidence of that, just go to any stock like Piton, go to Dollar Tree, go to HCAT, stocks where there's as much as 100% insider selling happening, but yet people still buy it. The fact is that emotionally we are programmed to lose money. Human beings are programmed to lose money. We always want to roll the dice. We always want to hope that our trade goes well. Because of that emotional element, I think that the mistakes traders make today will still be the same mistakes traders make 10 years from now. Ask yourself that. How many times have you been in a trade and know that you should get out of it? It's gone past your stop loss and you don't sell. And you hold on anyway, hoping that something good's around the corner. There's a lot of emotional trading that still happens. A lot of people that will, ignore the rules. And there's even, and of course, a significant amount of people that don't know the rules. So, look, I don't think that even if there was a saturation point where every single person in the world suddenly knew how to trade properly, I think we're a long way away from that. Anyway, that's my thoughts. I guess the answer to that is we've been doing it for 14 years, and it's if anything, it's working much better than what it was 14 years ago because of the increased power of the algorithms. All right, and okay, so that's basically a summary, guys, of everything that's included. And one last part to that is you also have the smart money indicators. So when you get your login information tonight, your login username and password, you go straight to our trading center, and the stocks above the 50-day moving average indicator is in there. The high yield bonds charts are in there, as well as an indicator we developed on the S&P 500 that predicts the S&P direction shift up to about 92% probability. We backtested it over 60 years. Over 60 years, we get 24 signals a year, 2 directional signals on the S&P every month, and just under 92% of them have been correct for 60 years running. The last 12 months it's been just under 85%. Last year it was 82%. The year before it was 75%. But just under 90% is the average. And we've been using it live in live market conditions for 7.5 years. That S&P indicator is something we didn't have time to talk about today, but that is also included and in the trading center, so that all of the things we discussed earlier, you just simply click on the button and it's all broken down for you. We do all the charts, we do all the patterns, we do all the analysis for you. So all those smart money indicators you started out with at the beginning of tonight, they are a click away with daily written updates on everything. So, guys and girls, if you have any questions, then Greg's saying, should I leave Steve's strategies? No, definitely not. Steve's got some terrific strategies, and of course, I mean, this is not to say something you should do instead of. This is something that can complement anything that you are doing currently. You know, and what Steve talks about with the candlestick breakouts and the T line and things like that, you're going to find that complements what we do very, very nicely. Right. So, and from a patterns perspective, being able to scan for and be taught how to identify the highest probability trades. Like, there's so much information out there on different websites, and you know, knowing where to go. Like there's Yahoo, you know, some of the websites, Insider Monkey, Wall Street, Simply Wall Street, sorry, Insider Monkey, Yahoo Finance, Insider Cow. There's all this stuff, and it's just so much noise. And what we're going to show you is how to take all that noise, strip it away, and we go to one site, click one button, and know exactly A, B, C, how to go about finding the best trade. Right? It's and it really, really makes it simple and powerful. Chipmunk. Okay, very interesting. Thank you. You're welcome. Is this service for a year? It's for 3 months, so that concludes your 3 months of alerts, 3 months of live training twice a week. The Smart Money Indicators package, which you'll have access to. The Smart Money Scanning course, you have unlimited access to that. So it's you'll always have access to your Smart Money Scanning course, so you can log in at any time and access that. Your one-on-one training is available for the 3 months as well. Okay. All right. What platforms do your indicators and scanners work on? TradeStation, Thinkorswim. So that the scanner is done in an independent software. We don't do it on any individual software. It is done independent of that. Okay, so, but the indicators, we work on Thinkorswim, Metastock, TradeStation, NinjaTrader, TradingView, Wealth Charts. I think I've named them all. TC2000. Do the platforms work in Australia? Yes. Actually, there's a program I use called Incredible Charts, which is actually really good, and that covers Australian stocks as well, and it's actually made out of Australia. I also use TradingView and Wealth Charts. Those are the 3 programs I use. TradingView, Wealth Charts, and Incredible Charts. Okay. And you can do our strategies, and everything you would need to do would work on all 3 of those for Australian stocks. Okay. You're welcome, Greg. Alrighty. So that's what about TOS? Yes, Thinkorswim, absolutely. Yeah, there's some really cool. We have an indicator which we've designed in for Thinkorswim, which is an advanced version of money flow. If you've ever used money flow or Chaikin money flow, it's a really cool indicator that we've programmed into TOS that works really, really awesome, and that's actually also included in your package. I could tell you, talk for 2 hours about what's included in your package. There's a lot more than what is on the screen here. We are a huge believer in under-promising and over-delivering, so there are a few extra surprises that you'll get when you start to log in and explore your through the website. And of course, one of our coaching team will reach out to you tomorrow or the next day to welcome you on board and guide you through all the value that's there for you to start utilizing. Okay. Guys, are there any other questions before we close off? Despite the slow start, I know Becky and Jim have been extending their time very graciously to allow us to finish up the presentation. So I want to close things down in respect of their time. But very simple. To get started, acornwealthcorp.com/win. If you want to think of the value of this, what's it worth to you for the rest of your trading career to know exactly what the people at the very top are doing with their own money and how to interpret that data for every trade you take in the future? What's the value in being able to, in this very, very concerning market, to be able to find the stocks at the click of a button where the insiders are dumping millions and millions and millions of dollars? 100%, 200%, sorry, 100% across the board over 2 or 3 directors, all at the top level. And then combine that with the highest probability pattern to give you the timing, because it's not just about the insiders selling or buying. You then want to combine that with the highest probability patterns. And we also teach you that in the course. What are the 5 best patterns and what market conditions to use them in? So in this market condition, what pattern is best for shorting? And then combine that with your insiders, you've got a winning scenario. You'll have that knowledge for life. So just go to acornwealthcorp.com/win. And again, I want to have a huge thank you to our hosts. We were all struggling together with the gremlins of technology earlier. So thank you for your patience in working with us there. And thank you, everybody, for attending today. I hope you got a lot of value out of it. And I look forward to seeing you in the live upcoming alerts that we'll be sending out over the weekend. Hope you all have a wonderful, wonderful rest of your night. And again, thank you to everyone over at Candlestick Forum.
Thank you, Johnny. Very good information. Somebody was asking whether you use this information versus candlesticks. No, this is information that you put in your own mental arsenal so that you can figure out the combinations or the information that you want to concentrate on and produce your own good trading strategies. So it's not one versus the other. What is the combination in your own mind that would make you see trades or be in good trades with a much greater degree of probability? So with that, Johnny, very good information. Sorry for the delays getting started tonight, everybody. So we'll see everybody bright and early in the chat rooms tomorrow. We'll see you then.